Sumita Karir. Over the next 30 minutes, we'll be taking you through the top stories that we're tracking here on ET Now on Rush Hour from the world of business, politics, economy, and of course, geopolitics. So let's start then with a check at the global markets. Global markets, well, they continue to be jittery, even as President Donald Trump has said that the United States will negotiate with countries on tariff rates. President Donald Trump will be holding talks with Japan today and tomorrow with Italy. In fact, the Prime Minister of Italy, Giorgia Meloni, will be meeting him. In fact, earlier as well, he said that he is currently in talks with at least 70 countries around striking deals that are beneficial for the United States. While that may be the case, but uncertainty around China is building up as 245% tariffs have now been slapped by the United States on Chinese goods. President Donald Trump has authorized an investigation into national security risks, and a new tariff baseline for China was part of that release by the White House administration. In fact, the United States earlier levied 145% tax, but now that has been upped. China, meanwhile, has retaliated and has demanded for trade talks and has said that it will engage in trade talks if Trump shows respect. And China has also said that the country is willing to address China's concerns around American sanctions. So on the back of all of that news flow, Asian markets traded mostly lower after Wall Street declined overnight as investors are assessing quarterly earnings and tariff worries. They continue to weigh in on investor sentiment. Let's take a look at how trade on Wall Street is shaping up. Well, currently all indices are in the red. The Dow Jones is down by over 140 points. In fact, the Nasdaq has taken a major dive. It is down by close to 300 points, of course, on the back of news around Nvidia that has come in on curbs that will be imposed on AI Nvidia chips. And then of course S&P 500 is also down by close to 50 points. So that's how trade on Wall Street currently is shaping up. But of course the big focus remains China. So how soon talks between the United States and China can happen? What will be the outcome? And what are global markets digesting? Are they digesting uncertainty around the trade policy just yet? Let's put some of these questions to our guest who's joining us live right now, Jeff Dennis, who's an independent markets commentator. Thank you very much, Jeff, for joining us here on ET Now. In fact, I was just speaking about, whether markets have digested the pains or not, because we've seen a bloodbath over the past few days. A lot of bad news, however, many experts are saying that it is out. So how should investors now be looking at the market? Are they pricing in a middle path already as far as United States and China, as far as those negotiations go?
I think it's just very difficult to be sure. I think it's certainly the case that the worst of the selling appears to be over for now. And I think that's probably because a lot of the tariff stories that we're talking about here have now got priced in. Although, as you've just highlighted, we've got a long way to go in terms of negotiations within individual countries. For me, the reason why I'm still pretty cautious about markets like the US and also China is that this has got a long way, I think, to go before we get any sort of resolution in terms of trade talks with China or indeed with other countries. The UK seems quite close, but that may be the only exception. Meanwhile, I think the other thing that's worrying the markets, at least I think it has been over the last few days, is the risk of a pickup in prices once again, a possible spike in inflation because of the tariffs, and also notwithstanding the strong retail sales number today, which I think had everything to do with people buying stuff before the tariffs came into effect, I think there's great concern about the economy. So I think investors have still got to be very, very cautious here about assuming that we've hit the bottom.
Right, Mr. Dennis, in fact, just to add to that, even though China posted a better than expected GDP number, however, UBS has also downgraded its GDP forecast for China going forward. Up till now, the forecast was better, but going forward from here on, well, they are saying that they are factoring in a more than 2 percentage points drag on China's GDP growth. So how severe could the second order impact be, and how will that in a consequence be impacting the markets? What kind of an impact do you see on the markets as a result of that?
Oh, I think the second order impact here could be very, very significant. Basically, the GDP number in the first quarter, which was stronger than expected, had a lot to do with the flip side of the retail sales of the US. In other words, China's been exporting a lot of stuff to the West and to their trading partners, including the US, of course, until, before the tariffs really kick in properly. And so you had a big boost to GDP from exports. So going forward, that's going to fade away, and it's going to fade away pretty quickly as far as I'm concerned. And meanwhile, you've still got all the old challenges that China is facing in terms of economic growth, which are the very, very weak consumer and the softness of the property market. So I would not be too much excited by this Q1 number, because I think it's due to temporary factors. And therefore, I think the logic is going forward that the Chinese market will probably be under pressure once again as we start to see some economic data that start to flow through when the impact of these tariffs begins to happen.
Absolutely, Jeff. So what are going to be your top bets in terms of geographies that you're looking at?
Well, I think the big winner from the tariffs, the tariff chatter and the tariffs imposition so far, including, of course, the 10% we're seeing across the board, with the threat, of course, that the reciprocal tariffs come back on the table in the early part of, I guess, the early part of, where are we now? May. I think the big winner regionally is Latin America, which has held up very, very well, because Brazil, for example, will sell a lot of soya beans to China if the Chinese-US trade war continues at its sort of at the height it is right now, and other agricultural products as well. Brazil only faces 10% tariffs into the US. I think Mexico also will do relatively well, because tariffs are absent if goods, quote unquote, are consistent with the USMCA treaty. And then if you look at the data elsewhere in the world, India has been really resilient. And I think that will continue. India is barely down in dollar terms since Liberation Day. I see from your chart that it's pretty strong. Inflation's falling sharply now, and we don't know how much further it's going to go. And of course, we've had an interest rate cut. So I see India as being very defensive here. I see Latin America being very defensive. I think parts of EMEA will be defensive as well. Whereas China, Taiwan, to a certain extent, Korea, ASEAN region, they are, I think, will all be in the firing line here, so to speak, until we get these tariffs resolved, if we ever get them resolved.
Absolutely, Jeff, and that is something that we'll have to watch out for. But the United States largely is looking at building a coalition against China, and that's what reports are suggesting. So, of course, these moves indicate that US-China trade relationship would be a fractious one over the next at least couple of months, if not years. So how do you really expect the China plus one story to play out with respect to India? You stated that you're optimistic about India amongst other geographies, but how do you particularly expect that story to play out? Because, there is optimism around China plus one. However, experts are also suggesting that it may take a lot of time before supply chains are shifted completely to India.
I think that's right. It will take a fair amount of time. But I think the point is, India is always a relatively defensive market in terms of EM. It's much, much more defensive and low beta than a Taiwan or a Korea or a China. And we must not forget that right now, before there's any suggestion these trade talks are starting, we're looking at 145% tariffs on Chinese goods into the US, 125% tariffs on US goods into China. So that relationship will basically break down. And although it will take time, as I say, for these supply chains to be shifted, they will get shifted over time. And so unless India gets walloped, the reciprocal tariffs that Trump announced and then paused, I see India as a big beneficiary here, in an environment also where suddenly I think the domestic environment looks a little bit more hopeful, because, as I say, you've got lower inflation and scope perhaps for at least another cut in interest rates by the RBI. So for me, it's a no-brainer here. India looks defensive. China is still very vulnerable because the trade war is very, very intense. It might improve, but we've got to get there first. And Trump, as we all know, does not like to back down.
Absolutely, Jeff. But by when would we see markets maintaining some sort of consistency, given that you just stated that we don't know when the United States is going to engage in a negotiation with China? So how soon before we see the good news on the markets front?
I think it's very hard to tell, and I'm not trying to be awkward and ignore the question. It's very, very hard to tell, and I think you simply have to play it day by day, week by week, according to what happens with these talks, because the flood of data, or as I should say, the flood of commentary and announcements out of the White House is just unbelievably strong and high. Um, my best bet would be that come sometime in the second half of this year, we'll get some sort of stability in the tariff situation. We'll get trade deals with perhaps a number of countries that allow the tariff situation to stabilize. And when that happens, investors and analysts can price in, can analyze what's a fair value for a market, what's a fair value for a currency, what's a fair value for a stock. But we've got to get there first. We haven't even had one trade deal yet. These trade deals are hard to negotiate. Although the UK may be close to one, I think the best bet at the moment, as I say, is to favor stocks that and countries that are not going to be hit by reciprocal tariffs. I mean, 10% on Brazilian exports to the US versus 125, I should say, for Chinese, I'm sorry, 145 for Chinese exports into the US. That's a kind of a no-brainer, frankly. And a lot of these third countries are going to pick up market share in China because the US is going to be unable to sell some of their goods into China. But it'll take a long time to settle that. Meanwhile, in the short term and the medium term, we have to expect there to be signs of recession in the US, weak growth, which I think are also going to pressure markets. So I think it's going to take a while for this to work itself out. And I think we may be in a better position to take a closer look around mid-year or into the early part of the third quarter.
Right, Jeff. In fact, as we speak, are of course noting that Nvidia's shares have sunk 7% on these Chinese ship curves. In fact, that stock is tumbled 8.1%. In fact, Wipro is also down. Some other shares are also down. So Nasdaq, of course, that is trading lower. That's currently trading, lower than 300 points in a trade as of now. But speaking specifically about the European markets, now that Italy's Prime Minister Giorgia Meloni is going to have a likely engagement with Donald Trump, perhaps a deal as well with Donald Trump, how do you really see the European markets getting impacted? You also stated that the UK FTA, a deal with the United Kingdom, could be the first one to come up.
Yes, I mean, I'm only repeating what I've seen in the media myself about the UK. Obviously, I've got no inside track on that. One thing I've not said, which needs to be said, which is very important for the European story, is that the dollar has been surprisingly weak, although, of course, in the last few days, it has stabilized somewhat. The dollar trade weighted is down about 4% since the so-called Liberation Day. And what this is which is indicating, along with, of course, the rise in bond yields, is investors, to a certain extent at the margin, fleeing the US because of concerns over its safe haven status. A lot of that money has gone into Europe, and Europe has been outperforming. Now, if the euro goes too high, that'll cause pain for some of the European exporters. There are many of them. But right now, unless this is the trough of the dollar, which I very much doubt it is, I think it may take time to break lower again. But assuming the dollar breaks lower again because these trade negotiations take a long time because of the recessionary risk in the US, etc., that is going to encourage more and more money to come to Europe, and we have to overlay that the chances of there being some sort of trade agreements between individual countries. That'll be easier to do, I think, than a big trade agreement with China. So all of that points, in my opinion, in terms of developed markets anyway, to favoring Europe over other parts of the world.
All right. In fact, as you speak of Europe, let me also take our viewers through what happened in the European markets. Well, the European equity markets, they recovered some lost ground after China indicated a willingness to engage with the United States president, provided the Trump administration shows a more respect, as China has stated. On that note, thank you very much, Mr. Dennis, for joining us and sharing your thoughts with us on where do we stand in terms of the markets and what to look forward to. Appreciate you taking the time out and speaking to us.